So next type is, next part is types of a bond investment. Okay. So first type I would like to discuss about zero coupon bonds. Zero coupon bonds. So what it means exactly when we say zero coupon bonds. So zero coupon bonds, I have something in Excel. Let me just go through it. So zero coupon bonds, it means bonds that do not pay interest during the life of the bonds. Instead, investors buy zero coupon bonds at a discount from their face value, right? Which is the amount that investors will receive when the bonds mature actually. So that bonds you can call it as a zero coupon bond. So in a simple term, if you ask me how zero coupon bond works, let's take an example here. Okay. So that is, it is not accuracy. Hmm. The actual face value of a bond is 10,000, but the issue price of a bond is 7,000. So it means this is something OID. OID, it means actually it's a fees or gain which you can see on a discount issue, the discount on issuance of a bond actually means at the time of issuance of a bond you can see a discount of 3,000 on a bond investment. So that's when we'll call it as a OID fees or OID investments or discount basically in short. Discount is the expense of a company. It's like an interest payment and the same amount the investors will treat as a gain on bonds amount or bonds investment. But if you see, let's say this bond has a maturity of, this is the bond investment terms. Company issued bonds at uh, zero coupon rate. Maturity, let's say it will mature in 2030. Face value of a bond is 10,000. Option cash, so it means it will redeem in cash at the time of redemption. And redemption price or maturity price of a bond is 10,000. So it means investor need to invest 7,000 and investors will receive 10,000 because this is the actual value of investment. So now at the time of, let's say, buying bonds, investors just need to pay 7,000 and investors will receive 10,000. So if you put this in this graph, how it looks like, every year company may book discount or OID fees, or as a OID, it's a expense for a company, which is original issue discount, stands for OID, stands for original issue discount. So for a company, it's a discount. So company will book the expenses. So every year company will book the expenses of like divide with 5, uh, so 600. So every year company will book 600 in the books of company as a liability. All right. And at the end of the period, if you see, total amount would be around 3,000. So that 3,000 company will pay 3,000 of this amount and 10,000 of the actual face value. So total 13,000 company will have to pay it. How much? 13,000. So company will have to pay, oops, this much of amount. Look at this. 13,000. An investor will receive 13,000, but investor invested 7,000. Oops, this is a written amount. So 10,000. Then OID income, original issue income, oops, 6,000, sorry, 600, 600, 600 and 600. Original issue discount is mm, 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 600. So total now you can calculate 3,000, but this will receive it means investor will get to know 3,000 gonna receive from the company, right? So at the time of investment only investor will get to know 3,000 amount. So this is would be like OID income, original issue discount income. One will book as a expense, means company will book as a expense or a liability, and investor will book as a expense throughout the period. Okay, so remove this term. So it's not good. So OID expenses, OID income. So total payment, if you look at this one, means how much total payment that the investor is going to receive from the uh, company. So total payment investor will receive 3,000 plus this maturity value, this 13,000. So now if you compare this 13,000 and this 13,000, so this is how things works, guys. At the time of investments, company receive 7,000, right? Investor pays even 7,000. So it means investor invested 7,000, but investor receives, my bad. I think we have missed with calculation face value. So not 13,000 actually. Sorry. Uh, at the time of maturity, sorry guys, we missed some calculation. So total amount it will receive 10,000, not 13,000. Why? Because the anyways issue price was 7,000, but the face value is 10. So it means actually investors will receive 3,000 as a profit. So total amount like maturity amount 7,000 and OID expenses where company will repay it. So total 10,000 company will pay it, and investor will receive the same. How much? The 7,000 which was invested at the time of maturity. So this 7,000 plus OID fees. So total 10,000 basically investors will receive it. So now if you ask me, sir, what is the benefit of investor in this case? So benefit is simple. So investor invested amount is 7,000 and returned amount which is 10,000. So calculate net profit, total returned amounts minus 7,000, which is 3,000. So would be the profit of investor in this case. So this is how your basically zero coupon bonds investment works. So any question on zero coupon bond? Now, if you ask me, sir, how bonds looks like, here is the image. Let me just increase the size. See how bonds looks like. On the note, you may see name of investor or name of who have issued bonds, then series, number, tracking number, then sign of authorized person. So that you may see on the bonds investment. So basically, the investor purchase these bonds initially by paying 7,000 to the company, and then at the time of maturity, company basically purchase bonds from the investor by paying 7,000 along with the committed amount or interest payment. So this is how bonds investment works. Okay. So any question with zero coupon bond? Investor pays original amount. See, if you ask me now, Flo, how exactly what happened? When company issues bonds, investor pays money to the company, and then company an investor purchase bonds from company. So company then transfer bonds to the investor. So this activity happened at the time of issuance of security. Then at the time of maturity, this bond at the maturity that goes to the company, and then company repay the money with like maturity amount plus the OID income which is committed. So that received to the investor like this, uh, principal and OID income. I hope now you got it. So how actually things works? It's just a exchange of a cash against bond instrument that happened at maturity. Okay, so let's talk about the other bonds also. How actually means different bonds that works. Let's say now the another type that we're gonna discuss is redeemable bonds. Redeemable bonds. So let me see if I have any flow. Face value, face value, face value. Mm, I had something to. Just give me 2 minutes. Let me just quickly check. I had something in my diary with the directions. If not, yeah. So now the another type that we're gonna discuss is we all the terms basically all we have discussed. So I don't want to discuss these terms again and again. Yeah. So the another type of a bond is guys redeemable bonds. So redeem bonds will redeem in cash, or sometime bonds may redeem in different asset class also. Instead of cash, maybe equity, maybe preference equity, right? So that depends on the company's financial situation, because at the time of maturity, if company is facing any problems, let's say liquidity problems, they don't have a cash in the bank account to repay the debt. So they may convert their entire debt into equity. So that's what it comes under restructuring. So company always hold rights, rights to exercise first right. So always company hold the rights and accordingly take the restructuring decisions. So while investing, you should check all the terms and condition If company says at the time of redemption, company may convert bonds investments into equity, then you should not invest. Now you tell me, if any company is highly growing firm, then why they need to convert a debt investment into equity? See, only those companies prefer to convert bonds or loans into equities. The companies which are facing liquidity issue and they don't have enough cash flow in their business. That's when they may look for a restructuring of a debt. But that's restructuring looks like roll over. So it means equity capital, sorry, debt capital now, the company is rolling over into the common equity. And you should avoid those investments. Now your question would be, sir, where we get that information? In the prospectus of investment. See, why government also or RBI push companies to basically publish the investment risk declaration, so that investor will go through it and take the informed investment decisions. But in a most cases we do not check any investment prospect as such. We directly purchase investments or bonds from the broker without having thorough analysis of that particular asset. Am I right? Yes, that happened in general. We don't check it. But trust me, guys, if you don't check, you may lose your money. See, the financial market, if you believe that, if we just, if we just go through the some freaking stuff like, charts or all of this, the different strategies like Garuda strategy, elephant strategy, or there are many more, because nowadays so-called people, they are coming with the different strategies and giving gan on YouTube so that you can be, billionaire. Go and check the data. The only 1 or 2% people, they're making profit out of it. 90% people, they're losing their money. Why? Because they don't check and read the details of investment thoroughly. And sometime what happened, like even if they read, they won't be capable to understand the complex jargons of financial market. So when I said exercise of a rights, what if, let's say, at the time of company, if a company hold the redemption rights, so it means first come at the time of payment, means repayment of, let's say, debt capital. If company has a rights to assess the company's position first and then repay the debt, in a maximum cases, company look for a conversion of debt into equity. Why? Company will simply avoid company will simply avoid repayment, and this is actually a loss of investor. Why? Because he'll get the equities now. What if after conversion of debt into equities, this in a share price of a stocks, let's say, crash in the market? Why? Due to maybe higher supply. Suddenly there will be a high supply of shares, because company will create a new shares and issue in the market. So there are a lot of technical things so that we should understand it before investing. And especially you should check the investment types, redemption at maturity. So redemption at maturity, it is possible in cash and possible in stocks or preference equity also. So you should check that, and you should prefer to go ahead with cash only. Okay. So I hope now you get it. What is the meaning of redemption at maturity? So if you want to invest in a redeemable bond, so you should check the redemption at maturity types. So it should cash. It should not any other. If it is, then it is not good for you. You may lose a lot of money in the bond investment. Now, if you ask me, sir, what happened in case of redeemable bonds? See, redeemable bonds, those are like plain vanilla bonds. Plain vanilla, it means simply offer coupon rate 5%, 6%, 7%, so that you can redeem at the time of maturity. Sorry, every month, every quarter, or every year, depends on the interest payment cycle, you can redeem the coupons. So that's that coupon bonds, means simple coupon bonds, you can call it as a plain vanilla bonds. And those bonds, comes under like redemption at maturity. So what happened now? Let's discuss that. Let's say bonds committed, terms of the bonds are like 5 years. Face value of the bond is 1,000. Issue price of the bond is 1,000. So it means bond is going to offer interest payment. The types of the bond is par, and the interest payment, let's say 10%, which is a fixed, and pay cycle is, let's say, yearly. So every year company will pay 1,000 rupees to you guys. So you can book 1,000 rupees, like in 2025 you can book, when you will receive 1,000 rupees. 26 you will receive 1,000 rupees. In 27 you will receive 1,000 rupees. 28, 29. So every year basically company will pay 1,000 rupees to you. So that 1,000 rupees you can treat as an income. Company will book as an expense. And oh, oh, yeah. So investors book as an interest income every year. And at the time of maturity, so company pays this full amount, 10,000 in cash, and buy the bonds, back. At the time of maturity, technically what happened, guys? So company buys the bond back by paying maturity value and dues interest payment. So basically investor, so this, how this happened, you can, visualize in your mind. So cash, investor pays to the, sorry, company pays to the investor, and then investor sell it out the bonds back to the investor. So this is how your, at the time of maturity, activity happens. So investor receives their capital plus interest. Company buy the bonds back from the investors. And here you may see a different types of, redemption at maturity. For example, let's say 10,000 company want to pay in, split. So 5,000 now and 5,000 later on. So that's become partial redemption. And that we have already discussed. Sometime what happened, let's say total investment, total, the total repayment, which is coming at, let's say, 11,000. Assume it, because what happened at the end of the, the last investment period, company may pay interest payment, which is 1,000 plus 10,000 as a uh, interest. And when we say principal, it means main amount back. All right. So company may look, see, to pay this debt, guys, first understand this. At the time of maturity, it is essential to have a highly liquid cash with company. And if the company hasn't a cash, then how company will manage that payment? Because to buy these bonds from the investors, company will have to pay amount. So it means that amount, it should be there in the bank account of a company. If it is not, then how company can buy that bonds back from investor? Cannot. They cannot buy it, right? Then we will, means, in that case, then company may announce default as well. So the point here is, sometime what happened, now let's say company will have to pay total of 11,000. So if company want to pay total of 11,000, so company will have to make sure that the company, should have to have 11,000 in their pocket or bank account. If not, then they cannot. So let's say what happened in this case, company has only 10,000 to pay. So it means in their bank account, company's bank account. So at the time of maturity, they got to know they have only 10,000, but their liability is 11,000. So how they going to manage the this 11,000? So basically company will pay this 10,000 first, all right? Company will pay, let's say, the bonds investment is like this. So company will pay, buy the bonds, and maybe for interest payment, company may ask for conversion of, bonds into equity. So company may ask for it, and let's say per equity uh, share price which is at 100 rupees, and then company may sell. Wait a minute, let me just put it in a sequence. Oops, we just need 10, 9, 9, 10. So each stock price which is at 100, right? So company can convert, guys, this interest payment, pending interest payments into stocks, and company may add new stocks to the, existing one, and transfer this, all of the sell stocks to investors. So basically, now see, investor was at, let's say, assume it, investor was div with this. One is interest and another one is principal. At the time of maturity, company paid, principal and taken, the bonds back. But now company is due with interest, and investor is expecting $1,000. But now company is asking, look, we are not in a position to pay you, let's say, you know, the 1,000, that the interest payment. So what we can do, the best thing would be we can convert that convert your interest payment into shares. So we'll give you, let's say, total shares of this 10 shares for thousands, so that you can sell it in open market and liquidate, right? So now technically, if you see, company don't want to spend money. Just companies asking investors to, take the money back from the uh, open market investors, but they'll transfer the share certificate to you. Just go to the open market, sell the shares to the other investors, and take your money back from them. So basically, company is not ready to pay from their pocket because they don't have a money in bank account. They have only 10,000 to pay a debt. So now, guys, here two things that you can learn. This process or this type, you can call it as a convertible bonds. So bonds will be converted into different security class, right? So from bonds to stocks. So that's become convertible bonds. Now your question would be, another two things you can learn it from here. One, so can company only convert interest payment into equities, or only, let's say, principal? Yes, depends what they want to convert, and how, the investor agreement was signed, or placement agreement was signed, or how their investments, let's say, capital, restructuring strategy is. So that depends on, certain factors, and then only company will come up with a restructuring. But in a restructuring, the class of securities will change from bonds to equity, and the investors may go into the, open market and sell the shares to the others, like, in a the usual process what we do. We just simply go to the market and purchase equity and sell it out to others at a higher price. So same pattern may apply it here as well. Okay. So the important point here is, guys, so two things, as I said, the discount, so that you can uh sorry, not discount, my bad, what I was saying, here two things that you can learn. One is the redemption at maturity, right? So redemption at maturity, it should be cash if you want to invest. And second thing is convertible bonds. So company may convert the bonds portion into a different asset class, so that it could be stocks, it could be uh, preference stocks, or it could be anything. So depends on the company's strategy. But this strategy or this type, you can call it as a convertible bonds. So most of the big investors, what I have seen, big investors, see, if now your question would be, sir, at the time of investment, if you participate in convertible bonds types, how we can, take a good, investment decision? See, if any company, if you feel that, guys, their equity may grow in the market, and that equity growth is linked with the basically business model. If the business model is, let's say, really good, and it may generate, you know, uh, 50%, 60%, 70% revenue from the current level, then you don't need to worry about at all, right? And if company, let's say, management is like efficiently managing cash flow or working hard to maintain everything, uh, they have enough transparency and all, then in that case, definitely you should look for a convertible bonds. Basically, once the conversion happens, so you may receive good amount of money from the market. All right. Or even you can earn dividends also. So that's something, different part. But anyways, so point here is convertible bonds are also good if you see a good prospectus of a company. But the unfortunate part is, in the most cases, companies convert the bonds into stocks because of their worst financial planning, and they are incapable to manage their debt. In that case, it is risky to invest in such a bonds. Okay. The another term you can, learn from this process, which is a payment in kind, PIK. For interview, it's important one. Payment in kind. Payment in kind. If company is not able to pay, let's say, main amount in a cash, then instead of cash, company may pay, same cash in other form, which could be stocks or any other assets. So in that form, you can call it as a payment in kind. So in this case, if we see the delayed interest payment, which is at 1000 K, company is paying in a 10 stocks, where the each stock has a price of 100 rupees. So total would be 1000 shares, 1000 rupees value of shares. So this process, you can call it as a payment in kind. All right. So we have learned three types so far. One is discounted bonds. Another one is like redeemable bonds, means redemption at maturity. And third one is convertible bonds, conversion of bonds. So conversion will happen into a different asset class of a bond. Now, let me cover the two more types. Mm, oops. Convertible bonds, restructuring of a debt. There are two more types which I want to discuss quickly, but yeah, so this one, putable and callable bonds. Have you heard about putable and callable bonds? I think this is a callable. Yeah, this is for callable bonds. It's very interesting one, guys. Putable and callable. So let's go to the here. I'll draw in screen. So first we'll discuss about callable bonds. This is very interesting one, callable bonds, that every professional, it is must to know this. How, if you want to, let's say, build your business empire and want to raise funding through different financial instrument, then you should know this instrument. Same for investors. If you're a smart investors and if you want the rights to switch your investments as per the market position, then again in that way also, it's good to have a rights with you for your investment. So in that sense, there are two types of bonds. One is callable bonds and another one is putable bonds. Callable and putable. So first we'll discuss callable. Let's say there is one company, uh, uh, so company called ABC company. So if you understand callable, then you can, same example that work actually, vice versa, you know, for a putable bonds. And then after we'll close the conversation for types of a bonds. So yeah, and there are two other terms are also there. So that I want to also, explain along with maybe examples that we can cover. Okay. So ABC company, let's say, issued bond investments, you know, issued bond investments for the milestone is uh, for 5 years. And the investments will mature here. Means after 5 years, investment will mature. Okay. See, at the time of issuance, very important, thing here that you should understand it. At the time of issuance of a bonds, company may include the rights to buy the bonds back from the investors, after certain period. After certain period. Why so? Because there are a number of reasons. The one is interest payment. What if, let's take a hypothetical, situation. ABC company as we know, the interest payment is basically linked with the RBI policies, monetary policies. If interest payment changes, the again the market interest rate also changes, like up, down. So it's a continuous cycle, right? What if, let's say, as a ABC company, you are paying almost 10% interest payment to the bond holders, and there is a company called XYZ. That company is paying 7% interest payment. Let's say, as a ABC company, raise 1,000 crores capital by issuing, bonds in the market at a 10% rate for per annum. And the same, the company from the same line, they have recently issued and they have also, raised similar sort of amount, 1,000 crores from the market. See, look at the figure. 10% on 1,000 crores would be around 100 crores as an interest payment liability, right? So that the ABC company is paying to the investors. And on other hand, the XYZ company, the recently, raised 1,000 crores from the market at a 7%, and that company is paying only 70 crores on 1,000 crores capital as an interest cost. So here, as a ABC company can find opportunity to save interest cost of 30 crores, 30 crores. How? By exercising callable bonds rights. By exercising callable bonds rights. Okay. So now we'll discuss that how it's actually works. Let me define the prospectus. So this one is interesting one. So note down this, please. Let's say debt size, total debt, thousand crores. All right. So 1,000 crores company wanted to raise, then coupon rate at 10%, type call option, call option terms 2 years, total maturity 5 years, face value and issue price par, redemption price full. So this is how the company design their investment prospectus. Okay, key terms. So we are assuming in this case, like the bonds, it was issued in 2023. 2024, 2025, 2026, and 7. So basically, company is okay with the full payment here, which is 1,000 crore. And every year, company will pay, means interest of 10% on 1,000 crore should be 100 crore, right? Every year. Okay. So this is the investment prospectus of a callable bond. Now, look at the market. Okay. Let's say you are the owner of this ABC company. You have issued bonds in the market at a 10% coupon rate with fixed interest rate, because most of the corporate bonds should be like, the interest type would be like fixed. So it means it will not change it. Once you issued, it is issued. So throughout the period, let's say throughout the 5 years of period, as a uh, company, you will have to pay, 10% interest payment to the investor, no matter what, because this is how you have committed 10% coupon rate. All right. Let's say in as per the bond, schedule, you are holding the rights, call rights. So that may company exercise on the basis of market situation, right? So let's say on a market screen, let's say this is a market screen, interest rate. So who announced interest rate? Of course, RBI announced it. So let's say RBI announced interest rate in 2023, it was 10%. See how market, your actual means capital restructuring decision with market interest rate. So you should understand from this case study basically. So interest rate which is at a 10%, the year was 2023. Let's say in 2021, the interest rate again it was same, or maybe uh, it was just 9%, right? But in a 2024, beginning of the 24, you may see you are still waiting for to change the rate. And again, at the end of the or maybe let's say at the end of the year of 2024, so due to market uh, or RBI policies or inflation and everything, considering all of this, RBI reduced the rate from 9 to 7%. And let's say the current market interest rate, which is at a 7%, right? See, when as a company you issued bonds in the market at that time, interest base rate or interest rate was at 10%. So it means you were paying, or assume it, you have paid 100 crore as an interest payment to the shareholder. So as I said, interest payment is a cost of a company and that impact on a profit. More interest payment, more cost to the company, right? And already you have paid it. So now as a smart, you know, founder or businessman, what should be your next move? So your next move, it should be, you should check and assess the market interest rates, right? Market interest rate. And there should be a, means, at least, means there should be difference in a way, like, if you try to reissue the bonds in the market through different series, so at least you should be in a position to save some amount. It's not like, let's say, because 1% on 10%, if you see in a 2024 beginning of the 24, it could be, let's say, in the month of January, when the rates got changed from 1 to uh, sorry 10 to 9%. In this case, your saving would be somewhere around just 1%. So 1% on 1,000 crores, which is at a 1 crore something, right? 10% would be 10 crore. So 1% would be 1 crore in that way. Sorry, my bad. 10% would be 100 crores. So 1% would be 10 crore, right? So 10 crore again to issue the bonds, to issue the new bonds in the market, it's a costly game, guys. So to issue the 100 crores bonds in the market, it will cost you somewhere around 10 crores. So to save 10 crores, you cannot, take a risk to reissue the bonds in the market, because it's not necessary that every time you will get, investors to invest money in your company. So it's not necessary. Sometime your events may fail. Investors may not invest money in your company. So you may see lot of ifs and buts. So while taking any restructuring decisions as a company, promoter, or as a company, let's say, decision maker, you should always think, and evaluate certain points. So you cannot, just go blindly and announce it, look, I want to reissue the bonds. No, though you have a rights, but you should, take that decisions or utilize that rights in a very proper way, so that you can manage, your capital risk. So now in this case, if you look at the now change in 2023, the interest rate was 10%, and in a 2024 of, let's say, in the month of December, the interest rate, which is at a 7%. And maybe as an entrepreneurs, let's say you have done sort of research and you got to know interest may fall in future also. So what it means, see, instead of paying 100 crore interest payment every year, okay, instead of instead of paying 100 crores per year, as a cognizant businessman, what you can do, you can exercise this right. Exercise right, it means exercise this right and buy bonds from market. So whatever bonds are outstanding, let's say 1,000 crore bonds are outstanding, buy it from the market, pay the 1,000 crores to the, shareholders, because you have a rights. You can ask bondholders to surrender the bonds so that you can buy it and resell. sorry, my bad, not reset, then issue new bonds again for 1,000 crores, but here the interest rate would be 7%. You get it, guys? What I have done here. So look at this. As a company, if the interest rate continues, let's say, goes down, if you have that, some sort of analysis, then call rights you can exercise as a company and buy the bonds from the investors, repay their debt, interest payment of, for 2 years like 2023 and 24, and 1,000 crores principal, repay that, and then issue new bonds for a same 1,000 crores at a 7% interest payment. So then after post, 2000 means 24, your interest liability looks like this. 7% would be 70 crores. So every years then you can pay only 70 crores. So now look at this, how much, rest full payment maturity, that remains same. But every year company can save somewhere around, let's talk about saving, guys. Saving of interest cost around 30 crore. So every year company can save 30 crore of saving. So this is how callable bonds works. So it's a strategic, tool that most of the companies hold the rights to exercise rights, and that that would be of course based on the current circumstances or the interest payment. And this is how company actually save the money. But if you see only, the penny difference like 10 to 10, 9.5, 9.2, 9.3, and if a bond size is big, let's say 1 lakh crores, 2 lakhs crores, and if you see a really big, the difference, like in this case, on a 1,000 crores, the loan, you can save around 30 crores for per annum. And this is a decent amount, right? So that 30,000 crores you can utilize to repay the debt. Basically, you can repay a principal amount by saving, extra interest cost. You can reduce your debt of almost 100 crores in next, 3 years. So this is how, as a founder, you can look for a saving of money. If you have a right strategy, then only you can save it, otherwise you can't. So say to save money, it's a strategic, decision. huh Now your question would be around, look sir, we have raised 1,000 crores because we wanted a capital, and now you are asking, to exercise rights, then buy the bonds back from the investors, pay their original capital 10,000 crores. Then how can we manage, all of this? See, to issue the bonds in the market to raise capital, as I said, it's not a easy task. To raise 10,000 crores, sorry, 1,000 crores means fresh capital, and to hire a banker, hire a merchant banker, hire a capital provider. So you will have to basically spend at least 10 crores. Then only you can, then only you can be able to launch 1,000 crores private investment on different platforms. So it means in this case, you don't need to pay, as a company, you don't need to pay any penny from your pocket. So what you can do, only pay the 10 crores to raise additional, thousands crores from the market. You can hire an investment banker. You can hire merchant banker. You can hire, let's say, XYZ partners who can provide funding to you for a short term, so that you can pay them, interest cost, maybe 2 crores, 3 crores, 5 crores, or 1 crores per month. So depending on the negotiation. So you can pay them an interest payment, right, for a short funding, for a 6 months funding. And then Meanwhile, just ask investment banker to manage this entire show, issue the shares or bonds in the market. Means reissue the bonds in the market, and you can focus on your business. Just pay 10 crores to them, they'll manage it entire show, and you can manage your work, and basically they'll help you to save your 30 crores per annum by reissuing new shares, and this comes under basically restructure of a debt capital. I hope you get it. Means how this, what I would say, callable bonds works. Okay. Sometime you may expect question around this, like why bond price and bond interest has an inverse relationship. So what is the meaning of inverse, guys? When the bond price goes down, interest it also goes down. When the bond price goes up, interest also goes up. Why so? And why suddenly happened that? See, basically what happened now, if you look at this one, actually bond interest, this company means before exercising a call, this company was paying 10% coupon rate. What if there is another company who is paying 7% interest rate? Because interest rate goes down. If the interest rate goes down, then people they'll not participate in such events. If the investor has other options like this, for example, there are two companies. One is ABC company, another one is XYZ company. So XYZ company issues bonds in 2025, and this company issues bonds in 2023 with the the coupon rate 10%, and here coupon rate is 7%. Now, if I ask this question to you, let's say that you are in 2025 as an investor, which company you would prefer to invest? ABC company or XYZ company? Come on. Which one you would prefer? ABC? If you ask me, I would say ABC company. I'll prefer ABC company, not XYZ. Why? Because XYZ company is offering only 7% interest rate. So it means when interest rate goes down, guys, the bond price goes up. Why? Because see, suddenly you would see the demand of this ABC company bonds will increase in market, right? And due to just demand and supply game, you may see a price change, means positive price change for ABC company, because suddenly demand will increase. And if interest rate goes down, so bond price also goes down. Why? The reason is, but see, the price goes up for existing bonds, not the new bonds. So understand this logic as well. And for XYZ company, if interest rate goes down, list means would be the investors should be like list interested in buying bonds of XYZ company due to low interest rate or coupon rate. So this is how you can see the bonds has a means bonds price has an inverse relationship with interest payment, but not with the current bond. So inverse relationship has with the existing bonds which has already issued in the market. Okay, because most of the investor what they think, okay, the current means the actual the current bond price will goes up. No, it will not. Means existing bond price it will goes up due to demand and supply, because most of the people they'll prefer to invest with the existing bonds which is offering higher interest coupon rate. I hope you get it. All right. So this was the example of callable bonds type, guys, and this is highly famous. Most of the in companies, basically they hold the or hold the rights or issue the bonds with callable option to take the inform the capital budgeting decisions on time to time. Now there is a one more type which is putable bonds. The difference between callable and putable is the story remains same. There is no change in the process. So instead of investors, basically, you know, sorry, instead of company, so here at this stage, investor get the rights to exercise, and that would be a basically for investors, put rights. Put it means sell. So investors get sell rights to the company. So then investors may participate in the other schemes as well. For example, let's assume it. Why investor will look for this? I'll tell you. Let's say this ABC company is offering 10%. Meeting is being recorded. Okay, this investor is offer means ABC company is offering 10% interest, and XYZ company is offering 12%. Right. So in case of put, what you can do, see, anyways, with the ABC company, you are not going to get higher interest rate of 12%. Why? Because the interest rate is fixed. So every year you're going to earn just 10%. So it means if you switch your investment from ABC company to XYZ, so you can save 2% extra. Let's say you have invested as a big investor, you have invested 100 crores in ABC company. So 10% would be 10 crores somewhere, and 12% would be 12 crores. So you can earn excess of 2 crores if you switch from ABC company to XYZ. But how can you switch it? If you don't have a rights, then you can't switch. You will have an option like to go to market and sell it. Every time you cannot find buyer to sell your investments. So it's not easy to sell investment in bond market, right? Then what if you have a rights to sell your investment back to the company? Correct. So in that case, would be easy for you. So you can sell the investment back to the company, ask company to redeem your investment and pay, your 100 crores. And you can take the 100 crores from company, and then you can again invest that 100 crores with XYZ for a 12% interest rate. Why? Because of due to market. So now if I summarize, see, redemption, maturity, everything remains same. There won't be any, change at all. Only the change is like holding rights. So now in case of putable or callable option, if you ask me to summarize it, how exactly, this works. Putable bonds, investors, if they have a anticipation where, or if they have a other alternative options where they can generate more income from the current investment, uh, current investment, then they always try to exercise rights, sell the investment back to the company, and they'll deploy the capital in another asset class. So it means if the interest rate rise, most of the investors will sell the bonds back to the company. Most of the investors, because they want to participate in other bonds. Or what if, let's say, if a same company ABC, ABC company only, what if ABC company launch another series B of a debt capital funding that they want to raise additional 1,000 crores, and now this time they're offering 12% interest rate. So what makes sense? Let's say you're existing investor and earning 10%, and the new investors they're going to earn 12%. So now if you ask me, definitely I'll look for a switch. Okay. So I can basically switch my investment plan from A to B to earn more interest. But when I can switch it, if as a Hi, can you hear me, guys? Hello? Can you hear me? So, at the end, if we see as a investors, will always go ahead with the high coupon rate, because high coupon rate, it means higher income for you. So that's all. So basically, if you ask me now, again, key difference between putable and callable. Basically, callable, it is a rights where company hold it and exercise that rights after certain period. And if I talk about putable bonds, it means it's a sell and sell rights. Always investor hold it to sell the bonds back to the company after certain period. And both are different because one would be in the favor of investor, another would be in favor of company. So yeah, that's all. Uh, just so yeah, that's all in this session. I just wanted to go through this recording and let me know if you have any questions. But anyways, we are done with today's session. Thank you very much for watching this, guys. We'll see you next episode. Thank you.